part of Fidelity's strategy desk with Trey.
Hello, everyone. My name is Trey Jarrell. I'm also on the strategy desk team. And if you haven't heard about our strategy desk team before, just to briefly introduce ourselves, we work with self-directed investors and traders. Our goal is focusing conversations on education and discussions on the trading process to help out with making better decisions in your trading.
Yeah, thanks, Trey. So as Denise mentioned, this is part two. It's part 2 of 4. Part 1 covered kind of the building blocks of technical analysis. That is actually available on the Learning Center right now. For those of you who joined us last time, welcome back. For those of you who weren't able to attend, we will be kind of making some references back to part 1, but as long as you have a basic understanding of trend and price analysis, you'll be able to follow along without issue.
All right, and before we get started with the presentation, we do have a few disclosures that we need to cover here. First and foremost, any screenshots, charts, or company trading symbols mentioned are provided for illustrative purposes only and should not be considered an offer to sell, a solicitation of an offer to buy, or a recommendation of a security. Investing involves risk, including risk of loss. And finally, technical analysis focuses on market action, so specifically volume and price. Technical analysis is only one approach to analyzing stocks. When considering what stocks to buy or sell, you should use the approach that you're most comfortable with. As with all your investments, you must make your determination whether an investment in any particular security or securities is right for you based on your investment objectives, risk tolerance, and financial situation. And as always, past performance is no guarantee of future results.
Yeah, thanks, Trey. So Denise kind of mentioned what's coming up next, but here's an overview of the whole series. So again, part 1 was the building blocks. That's really where you start. We'll kind of reference that kind of throughout this part 2. Again, it kind of covers price analysis, trends, and so forth. Today is focusing specifically on technical indicators. Okay. Again, part 3 is identifying chart patterns. And then part 4 is going to be gaining confirmation and managing risk, really kind of bringing everything together. We do encourage you to attend all 4 parts, and again, we'll go over the dates and everything fully at the end, and you can register for all 4 of them ahead of time. So hopefully you'll be able to, join us for the whole series here. All right, so we do want to cover just kind of what we're trying to achieve in part 2 here. So really, we're going to kind of classify the different types of indicators. We're going to look at how they're constructed, some of them in detail, and more importantly, though, obviously, how they're intended to be used. Again, a common thing that's really going to be coming up is how we can use these to manage risk, be aware of the limits of these indicators and technical analysis in general, and really kind of where do they come into your entire trading process here. And that's really what we'll also demonstrate live on the ActuTrader platform at the end here.
All right, and then to get started, so we are going to be covering these various types of indicators here today. We'll be going over trend, momentum, volume, volatility, and finally support and resistance indicators. As we go through the presentation, we're going to be covering multiple examples of these various types of indicators. So as you're starting to learn from this and put together your own trading system, one thing you want to be careful of is what we call indicator overload. So in other words, you don't want to be using every single indicator that we cover today in your trading process. Generally speaking, traders are going to be using maybe just one indicator of each type. And a lot of the 4th part of our series on webinars will focus on that, how we're putting all this together in a final trading system. So let's go ahead and move into the first type of indicator that we're going to cover today, which are trend indicators. And before we go into that, remember, technical analysis really is based on one major principle, and that is the principle of the trend, right? Trends are going to arise from interactions of buyers and sellers, and ultimately, the more aggressive one is over the other, the steeper the trend, right? I think if we have more people out there buying, right, than selling, we're going to see ourselves in an uptrend. And just one other point too, today's webinar, again, we're focusing on just the indicator portion. It doesn't really cover all the trending tools. So some other common methods that are used to determine and analyze trend are things like trend lines and analyzing peaks and troughs, which we discussed in the prior webinar. These really are crucial components to trend analysis, but Today we're just going to focus on the indicator portion of it. And the first indicator we're going to look at today is the simple moving average, so also known as the SMA, and it's really one of the core indicators that are used in technical analysis. So we actually introduced the concept of moving averages in the first webinar, and we'll be covering them today specifically on how they relate to trend analysis. The simple moving average, it's constructed basically by taking the average price of a security over a specified period of time and then plotting it on a chart bar by bar. SMAs are commonly used to smooth price data and technical indicators. Think of it as a way to take some of the choppiness or take some of the noise out of a chart to give you a clear view. They are designed to detect the start, continuation, and reversal of a trend. If the moving average is moving up, this indicates obviously we're in an uptrend. If it's moving down, simply indicating we're in a downtrend. With moving averages, the periods that you actually use can be customized. So the longer period of the simple moving average, the smoother the result you're going to have. But there's going to be more lag that's introduced between the SMA and the source. If you use a shorter period, the trade-off is you're going to have less lag, but that's going to increase your likelihood of a false signal. Two of the most commonly used periods amongst traders are going to be the 50 and 200 period averages. 50 represents more of an intermediate trend, with 200 representing the longer trend. And we're going to show some examples of those on the chart here in a moment. And then finally, signals that are generated with SMA. Right? We're going to actually generate buy and sell signals. Think if the price of the security crosses above or below the moving average. So if we cross above the SMA, generating a bullish signal. Right? If the price drops below the SMA, that's when we're generating a bearish signal. Signals are also generated as SMA lines cross each other, so crossovers, which we'll actually focus a little bit more on that in a moment. And just one other thing, keep in mind, simple moving average, it's not the only type of moving average, so there's another common moving average, which we won't spend too much time on today, which is known as the exponential moving average. It's similar to the SMA, however, the big difference is it adds more weighting to the more recent prices. So let's move over to an actual chart here where we have SMA plotted. And what we're looking at here, this is kind of set up more as a way to illustrate varying sensitivities amongst different periods of moving averages. Most traders generally aren't going to be using the same periods that we're looking at here for trading purposes. As you notice, we have both a 20, 30, 40, and 50-day moving average on here. So let's start. Let's take a look at the bright red line. This is going to be the 20-period moving average. This is the shortest period that we have plotted on here. And if you look at the way it's moving on the chart, you can see the sensitivity it has to the price movement of the stock. So as the stock price changes, we see a much quicker reaction to the 20-period moving average on a day-to-day basis. Now, if you compare that to the 50-period, which is the purple line, you can see the 50 is less reactive to the changes in price on a day-to-day basis. It's giving us a longer term, smoother line. Traders do often use combinations of averages in their trading to have a sense of the trend over the differing time periods. And it also helps to manage some of the false signals and also can help confirm reversals through crossovers. If nothing else, it is very important to understand, there really isn't a right combination of moving average, right? The combination that's working for you, it's going to depend on your own time horizon for trading, and also perhaps the market environment we're in or the security that you're looking at.
Yeah, thanks, Trey. So let's kind of take a look at this in action here. So look at this chart, look at this example. Okay, so again, let's kind of start from left to right. So in this example, we're going to be looking at the 50. Okay, and the 200, and the red line is going to be the quicker 50 period, and the blue line is going to be the slower 200 period. So again, as always, you start by analyzing the price. Okay, so building off kind of part one of the series, we noticed that price kind of was horizontal, but then starts to turn up. It kind of appears to start an uptrend. You got higher lows or troughs and higher peaks. So bring your attention to the first circle. Okay, notice the 50 period starts below the 200 and then crosses above. Okay, So if anybody's ever seen this before, there's actually a name for it. This is what we call the golden cross. Okay, that's golden cross is referring to crossover when the quicker one crosses above the slower one. All right, and this can be looked at as confirmation that the uptrend is potentially beginning. But again, remember, you're always looking at price first, and we're using this as kind of a verification that what we see in the price, okay, is more likely to be true. All right. In addition, as Trey mentioned before, moving averages can kind of tend to act as support resistance, okay, with the price. So you notice that the price kind of rides the 50-day for a while, kind of occasionally tests the 200-day, okay, for a period of time. All right. Now let's kind of take our attention to the right side of the chart and kind of walk through the steps here. Again, first the price turns down, okay, then it crosses below the 50-period moving average. Okay, then it crosses below the 200. Right, price looks like it retraces upwards to the 200 and kind of stalls there. All right, this is kind of that concept of former support possibly becoming future resistance. All right, and then it reverts downward. Okay, and what that circle is pointing out is when the 50 dives below the 200-day moving average. Okay, this is the infamous death cross. Okay, all right. And this could be the first potential signal that the trend is potentially ending. Okay, and that's kind of what we're looking for here. All right. In addition, the 50 kind of appears to act as kind of a resistance line as price projects downwards. All right. So again, this is just kind of one example of taking it from start to finish. If this was your sole signal, again, are the 50 and 200 the right ones to use? Again, they are definitely very common. Many traders use shorter ones, or even potentially longer ones, depending on the time frame they're looking at. Just keep in mind that just the rule of thumb here is that the quicker or tighter, if you want to refer to it, moving average, they can give you earlier signals, but as Trey mentioned, the trade-off is you could potentially get kind of faked out or get more false signals with the quicker time periods.
Another important thing to notice on this chart, which is going to really something we want to think about when we think about technical analysis in general, right? And that is, we're reacting to price movements when we use technical analysis. We're not trying to predict the future with these. This is a very good example here because if you look, at the bottom left, right, we're not attempting to buy or give that bullish signal right at the bottom, right? We're waiting for the price to come up and we're reacting based on that. And same when we see the reversal at the end, right? We're not selling it at the exact top. We're waiting for the price to move down, and we're reacting based off of that, waiting for those signals. And, ultimately, you're taking advantage of that upward trend between those red circles. So very important aspect of technical analysis in general here.
Yeah, that's an excellent point, Trey. And so we're going to move on to the next indicator we're going to cover. And as Trey mentioned, again, there is another type of moving average called exponential. Again, it just gives greater weight to more recent price than the simple. We're not going to cover that in detail today, but we are going to cover one that's basically based off of exponential moving average, and that's the MACD, okay, moving average convergence divergence. So this is considered kind of a momentum, what's called oscillator, all right, kind of used to trade trends. And even though it is, quote, an oscillator, it doesn't have kind of theoretical boundaries. So because of that, it's not used for what's called overbought or oversold conditions. We'll get into that under the momentum section. Again, and it doesn't overlay the chart. This appears below the primary chart, and it's constructed based off of two lines, okay? And again, it's derived from exponential moving average. So MACD, okay, the line itself is if you take two exponential moving average periods and basically subtract one from the other. And the default is the 12 period and the 26. Right? And of course, depending on their relationship to one another, this can turn into either a positive or negative value. So kind of jumping into how this indicator works, when MACD is crossing above zero, okay, it's considered bullish. And conversely, if it's crossing below zero, it would be considered bearish. Secondly, if MACD is below zero and turns up, it's also considered bullish, and vice versa. Okay. Now, the second part of MACD is the signal line. Okay, and that signal line is actually just a exponential moving average of the MACD line, and the default is the 9-period exponential moving average. All right, and when those lines cross each other, okay, that can also be interpreted as a signal, and we're going to look at that on the next slide. Okay, so in a way, kind of MACD is very similar to using a two moving average system. All right, and we kind of just looking at this example here. So if you look at the red circle A, okay, MACD crosses above the signal line, okay, even though it's below zero, that is considered bullish. Okay, and B, MACD crosses above the zero line, okay? That's kind of like if the quicker period 50 was crossing above the 200, okay? That's where you get a positive value. So that's also considered a bullish signal. And then conversely, C, okay, price is above zero and turning down, and D, when MACD crosses below the zero line, both considered bearish. And you might notice this kind of blue histogram kind of overlaid in the background. And that's just kind of keeping track of where the MACD line is in relation to the signal line itself.
All right, thanks. So the last trend indicator that we're going to cover today is the average directional movement index, or ADX. So while the previous indicators we've looked at for trend, they help us define direction of the trend, the ADX line is designed to give us strength of trend. So the value of the ADX is proportional to the slope of the trend, and the slope of the ADX line is proportional to the acceleration of the price movement or changing trend slope. So if the trend is a constant slope, then the ADX value tends to flatten out. If after staying low for a lengthy time, for example, the ADX rises by 4 or 5 points, for example, we move from 15 to 20, it may be giving a signal to trade the current trend. Now, Wells Wilder is the one who developed this one. He suggested that a strong trend is going to be present when the ADX line is above 25. And if we're below 20, then no trend is present. When the ADX line turns down from higher values, it's a signal that the trend may be ending. If the ADX is declining, it could be an indication that market is becoming less directional and the current trend is weakening. And finally, if the ADX is rising, then the market is showing a strengthening trend. So let's take a look at an example here on the chart of ADX. So what I was talking about previous slide, really is focused on the average directional index line, which is the line that's drawn here, the purple line. And this is really here to measure trend strength without regard to trend direction. But if you notice, there is two other indicators that are plotted on here. This is the plus directional indicator and the minus directional indicator. They complement ADX by defining trend direction. So when they're used together, a trader can determine both the direction and strength of the trend. The directional movement is determined by comparing the difference between two consecutive lows and the difference between the highs. And also crosses between the plus directional indicator and minus directional indicator can generate signals on the direction of the trend. So taking a look at the chart here, if we focus on the highlighted red box, right, the top of that box is actually drawn right on the 25 line of ADX. And if we follow that purple line, we see this is an area where really there's no trend present. If we look up at the price of the security on the top portion, we can verify that. It seems very clear that we're in kind of a sideways trend. But what happens at the end of that box is we see ADX actually breaking above 25 and continuing up. This is an indication and giving us a signal that we're entering into a trend, and this trend is strengthening. And if we do take a look at the plus and minus lines at this same level, at the right here, we do see the plus over the minus line. So this is indicating that we're in a bullish trend here. If we kind of move over to the very end of the chart, the far right, if we look at the top, we see the price appears to peak, and now we're reversing and pulling down. But we also see the ADX line is now dropped below that 25, right? So that's indicating that we're leaving the trend, or trend is weakening. And we also see, if we look at the plus and minus crossover here, the minus line has crossed above the plus sign, again signaling more of a bearish signal here.
Yeah, right, Trey. And as you mentioned, what does price appear to be doing? So this is kind of the first place maybe we'll stop and say, trying to bring everything together, right? Well, it looks like we were previously in an uptrend, right? And building off part one of the series, right? If you drew a trend line, okay, would that trend line have been violated? And now ADX is saying, hey, potentially this trend is ending. And maybe even just stepping back, what we talked about at the beginning, maybe add some moving averages and so forth, crossovers. What signal is that giving you? Okay, starts with the price. The indicators are trying to help us confirm what we're seeing.
Great point, Robert. All right, and then finally, just to wrap up, we've talked about this through, but before we move on from trend, right, again, we were focusing specifically on the indicator portion of it, but trend really does require additional methods beyond indicators. The use of trend lines and analyzing the peaks and troughs is a major component when you're analyzing trends.
Yeah, and kind of we want to emphasize everything starts with the price, and you need to start with your analysis there. So if you're not already doing that, if you're using some of these indicators and you're just looking for these kind of signals that you just take kind of action on without doing additional analysis, remember that's not really how it helps you. Okay, again, trends, peaks and troughs, reversal points, all covered in part one. If you don't feel like you have a command of that, I definitely suggest you rewatch part one. So we're going to move on to momentum indicators. Okay, again, these are very popular because they do generate kind of signals, so to speak. And again, so we're going to cover what the term kind of oscillator means. And in this case, it's really what we call a bounded indicator, which means there's basically a high and a low limit that can be reached, typically 0 and 100. Again, when the oscillator reaches the kind of higher zone and the levels are kind of determined based on the indicator, that kind of reaches what we call an overbought condition, and vice versa. When it closes lower to the lowest bound, kind of referred to as an oversold condition. And typically, when it enters these zones, okay, price may be more vulnerable to a reversal, and usually the quote signal occurs when the oscillator exits one of these zones. But one of the things we really want to touch upon here is that it's not that simple, right? It's not green means buy, red means sell, right? You have to look further into the price, identify where you're at. Okay, the oscillators can reach kind of extreme levels, and sometimes that actually can indicate that the new trend has begun. Okay, again, you're looking at price, but if the oscillator say shoots to overbought, potentially a new uptrend is beginning. Right? When that's the case, these things can actually stay in the zone for an extended period of time and can give a lot of false signals. So, second to last bullet point, you really have to understand, what do I feel like the price is doing? Are we in a trend, uptrend, downtrend? Are we in no trend or a trading range? Okay, the interpretation of the oscillator is dependent on your first interpretation of price. So basically, a lot of times these will work in the kind of trading ranges, but they don't really work so well for signals when the trend is actually very strong.
Yeah, and just one other important thing as we're going through this indicator and other indicators, just remember, identifying signals and confirmations, it can be a bit of an art sometimes, right? It's not a perfect science. As you're using these, one thing you should expect to see some failures throughout the process, right? There's, no, again, perfect indicator, but it does take some time to study and familiarize yourself with these for them to really start working well for you. So, continuing on momentum, the first indicator that we want to cover here are stochastics. And what we're looking at with stochastics, there's two lines that are going to be graphed. We have a slow oscillating percent K and a moving average of percent K, which you'll see referred to as percent D. And these oscillate in a range between 0 and 100. What the oscillator measures here is the level of the close relative to the high-low range over a given period of time. So if we see the stochastic above 50 when the close is in the upper half of the range, and we see it below 50 when the close is in the lower half. So lower readings below 20 indicate that the price is near its low for a given time. Higher readings, above 80, for example, indicates that the price is near its high for that given time period. Two of the more common types of stochastics are going to be known as the fast and slow. Both of these are going to be ones available on Fidelity and Active Trader Pro charting. The difference between the slow and the fast really is the slow percent K incorporates a percent K slowing period of 3 that controls the internal smoothing of percent K. So think of it, if you compare the two, you'll notice the slow is going to cut out some of the choppiness, right? It's adding some smoothing to that chart to make it easier to read and easier to generate signals. But the way we're using this indicator, generally, when we see the area above 80, that indicates an overbought region. When we're in the area below 20, that's when we're in the oversold region. The 80 and 20, these are going to be the most common levels, but as most of the indicators will cover, you can see these can be adjusted as needed. So ultimately, a sell signal is given when the oscillator goes above 80 and then crosses back below that 80 level. Conversely, the buy signal is given when the oscillator is below 20 and then we cross back above 20. Crossover signals also occur with the two lines when they cross in that overbought or oversold region. And we'll also look at is divergences. So a bullish divergence is going to form when price makes a lower low, but the stochastic oscillator forms a higher low. And the bearish divergence is going to form when price makes a higher high, but the stochastic oscillator forms a lower low. This shows less upward momentum that could foreshadow a bearish reversal. And just to focus, one important thing is we've talked about the trend, right? Stochastics are most effective in broad trading ranges or slow-moving trends. So this is why it's important to, understand, where we're at in the trend before using an indicator like this. So we'll pull up a chart here with stochastics and take a look at an example. And, carrying on, obviously looking at the trend, if you look at this chart here, the price, it is very clear that we are in kind of a sideways trend here, right? So let's take a look at the bottom is where we'll see the stochastics drawn on the chart here. And let's focus on that first red circle right around July 1st. So what we see here is stochastics crossing below the 20 line, and your buy signal is actually generated as you cross back above it, right? As we move up to the red circle, see we cross above the 80, and your sell signal is generated as we cross back below it, right? And if you compare the actual price on the chart, you see it looks like the trade worked out fairly well. You're entering as you're coming off of the lows and selling as the price moves back off of its highs. So we also want to focus next on the blue horizontal dotted trend line, where we can get a really good example of a divergence and how you can use stochastics in confirming what's happening with the price. So what we see here is price is actually hitting new highs. We hit a high, and then a further high at the top of that trend. But unfortunately, stochastics is not confirming this, right? Stochastics is showing us a divergence. We hit that first peak, stochastics hits a new high. But as we hit that second price peak, stochastics does not hit that same high, right? This divergence is giving us a bearish signal, which ultimately played out to be correct, right? You see the breakdown in price shortly after that. All right.
Yeah, so the next momentum indicator is going to be relative strength, okay, also known as RSI. It's a very popular indicator, again, also developed by Mr. Wilder. Again, it's intended to speed and change of price. RSI oscillates between 0 and 100. Okay, traditionally, the levels that he said is that overbought would be considered when above 70 and oversold when below 30. And to kind of help understand RSI without really diving into its math, 0 RSI would mean that the price had moved lower in all the looked at periods, and 100 RSI would mean that the price had moved higher in all the look back periods. So again, 70, 30, are these ironclad? No. And again, even Wilder himself suggests that you may want to adjust them, based on the security that you're looking at. But again, one of the things we look at it for is RSI can also form chart patterns, again, which we covered in part 3 of this series, that may not actually show up in the underlying price, such as double tops and bottoms. You also look for trend lines on RSI, just like you do on price, and support and resistance. These last 2 bullet points are probably the most critical, and maybe somebody who uses RSI doesn't really if you weren't aware of this, this may be why RSI may not have been, quote, working as well as you might have hoped. When we're in like an uptrend or a bull market, RSI actually tends to stay above 40, with that 40-50 zone kind of acting as like a support level. And during a downtrend, it tends to stay below 60, okay, with kind of 50-60 acting as a resistance. So essentially, you do, again, need to start with, am I in an uptrend, downtrend, in a sideways market? Again, you can stay overbought or oversold for extended periods of times with some of these oscillators. Okay, and just like stochastics, again, there's that concept of divergence, right? If prices are making new highs or lows, but it's not confirmed by the RSI indicator, again, it could lead to a potential price reversal. And we're going to see some examples of that on the next slide. Okay, so if you look right in the middle of this chart here with the blue dashed line on price, okay, we see that prices are making a lower low. But then you go right below to the indicator, okay, RSI is both in the oversold category, but the pattern it's making is higher lows, okay? So that positive divergence, those are things we look for as potential signals. And in this case, in this example, it did happen to play out subsequently with a significant rise in price.
All right, so we're going to go ahead and move on to the next type of indicator, which are the volume indicators. All right, so an important thing, most volume indicators are actually measuring volume change rather than volume itself, right? There are many traders that do use volume itself rather than looking at an indicator. So we did cover that in a little more detail during the first webinar. So today we'll focus on a few of the indicators though. So just some general rules of volume that we need to understand before we move on. Right, very simple. Increasing volume generally occurs on a strong trend, and decreasing volume can suggest that the trend is weak and correcting from the major trend. Also, spike peaks in volume can warn of a potential trend reversal. And a very important thing with volume is we never want to use volume for a trading signal itself, right? This is really used for a warning of trend change. For example, many studies have actually shown that breakouts can be just as profitable with or without an accompanying increase in volume.
Yeah, thanks, Trey. So the first one we're going to cover is what's called the money flow index. All right, this is actually a momentum indicator that kind of adjusts for volume. It tries to measure the flow of money into and out of the security over a period of time. And it's actually closely related to relative strength, which we just covered earlier. But again, it incorporates volume, whereas the RSI only considers price. All right, so to kind of cover the calculation without diving too much into it, the MFI is actually calculated by accumulating what's called positive and negative money flow, and then creating a ratio out of those two figures. So the money flow starts with what's called the typical price, which is adding the high, low, and close, and then dividing by 3. But then it multiplies by volume, okay? And then part of this ratio is literally plugged into the same formula that RSI uses, okay? So this is why this index is actually sometimes called the volume-weighted RSI. So how does this work? Well, it works very similar. Oversold levels typically occur below 20. Overbought typically occur above 80. Again, as always, these are not ironclad. The levels may change depending on market conditions, right? Depending on different securities, some levels might work better than others. Again, so the oversold, overbought levels, they're not really reason enough to consider kind of pulling the trigger, so to speak. As with all of these, you want to start with your price analysis and have this be part of your process. And once again, that topic of divergence, all right? If the underlying price is making new highs or lows that isn't confirmed by this indicator, that divergence can signal a potential price reversal. You're going to see that's very common with many technical indicators. All right, I'm just going to take a quick example here. All right to the center of the chart, if you look at the blue dashed line, it's pretty clear that you see a price peak followed by a subsequent higher peak. But if you look below at the indicator, it's both in the overbought territory, okay, but the second peak on MFI does not actually, quote, confirm the higher price, right? And that divergence, okay, in hindsight led to a pretty significant fall in price. And then fast forward a little bit, there's the opposite scenario where you have price making a lower low on that second dashed line. Then you have the indicator in the oversold category. It's also making higher lows. Okay, and turns out that turned out to be a bullish signal there.
So the next common volume indicator we're going to look at is on-balance volume, or OBV. This one simply measures buying and selling pressure as a cumulative indicator, adds volume on up days and subtracts volume on down days. So just think of it simply, right, if the security closes higher today than it did yesterday, so we have an up day, all of the volume for that day is considered up volume and is added to OBV. Conversely, if we're a down day, we close lower than previous close, the volume is all considered down volume, and we subtract from OBV. Really important part here on how this indicator works. The actual value of on-balance volume really isn't important. What you're really focusing on is the line, and we're focusing on the direction, right? And the way we use this, when both price and OBV are making higher peaks and higher troughs, upward trend likely to continue. On the other side, when price and OBV are making lower peaks and lower troughs, to signal the downward trend as likely to continue. If we happen to fall in a trading range, if we see OBV rising, it's a signal accumulation may be taking place, and this could be a warning of an upside breakout. Also in a trading range, conversely, if OBV is falling, maybe a signal distribution is taking place and warning us of a downward breakout. So let's take a look at OBV on the chart here. Before we take a look at the blue trend line, let's just focus on the very left of the chart as we begin. What we see here is kind of the beginning of an upward trend, right? Price is continuously moving up, and OBV is confirming that, right? We see the direction of OBV also trending in that upward direction. But if we do move over and take a look at the bearish divergence, what we see by looking at price is that price is hitting highs, new peaks multiple times, and if we look down at OBV, it's not confirming that, right? We have a divergence here. OBV is continuing a downward trend, and ultimately see this divergence was very important. The price did, in fact, reverse and break down from there.
Okay, so we are going to cover an additional volume indicator. So this one is very commonly used as well, accumulation distribution. This one simply looks at proximity of closing prices to their highs or lows to determine if what's called accumulation or distribution is occurring. Then it's multiplied by volume. Okay, so again, the concept of divergence or confirmation, again, is the emphasis of this one as well. Just like OBV, the actual value is not important. You want to concentrate on the direction. So if the price and accumulation distribution are making higher peaks, higher troughs, reinforces that the trend is more likely to continue. Vice versa, if price is declining, accumulation distribution is making lower peaks, lower troughs, perhaps the downtrend is more likely to continue. Okay, and when you have that divergence, okay, maybe price making higher peaks, but accumulation distribution fails to do so, again, maybe that trend is more likely to stall or fail for both uptrends and downtrends, okay? And then kind of an important note, if you feel like you're identifying yourself in a trading range, okay, and the price is basically moving sideways or in a channel, the accumulation distribution also happens to be rising, okay, then perhaps accumulation is what's occurring, and it could be signaling a potential upward breakout. And the reverse is also true. If you're trading in a range, accumulation distribution is falling, that perhaps distribution is taking place and maybe a warning that a downward breakout may be about to occur. And we're just going to take a quick look at an example on the next slide here. All right, so if you look at the blue dashed line, okay, we're going to see rising price to a higher peak. But again, sometimes they're trying to see things that are not in the price. That's what these indicators try to tell us. Accumulation distribution is actually declining. And in this case, after a period of time, it foreshadowed actually a decline in price going forward. All right, so before we move on to the last two types of indicators here,
Let's just take a quick moment. I want to pause and see if we have any questions. It looks like there's a lot coming through. Denise, do we have any questions here at this point that we could answer?
Yes, we do. We have a few of those. I'm wondering if you guys can talk about periods. You had mentioned a period. You mentioned periods for a number of the indicators being used, and folks are wondering, is that just days, or is there some other period that folks should be looking at?
Yeah, it's a great question. So the period, it sort of depends. It depends on the chart that you're looking at and the frequency that you're looking at. So, a lot of the charts we're focusing here are on daily charts. So, if you have a chart pulled up and we're on daily, your period's going to be daily. What's important to understand about technical analysis, though, it is considered fractal, right? So depending on your time period, these same default settings should work on different time periods. So, for example, if you're someone who is trading very short term, maybe over the course of a day or the course of a week, your period may not be days. That might not generate enough signals for you. You may use a shorter period, maybe a 1 minute, 3 minute, or 5 minute, or perhaps even longer, right? If you're someone that trades over a 10-year pattern, maybe your period's not days, but it's weeks. So it is something that's customizable. But all of these indicators, are designed to work over year period.
Yeah, one thing I'll add to that is that it's tied to the frequency, so it's very important. So say you're watching the news and they're talking about like the 50 or 200-day moving average. They're literally talking about the 50 or 200-day. So if you have those settings on your chart and you switch to like some intraday, keep in mind it's tied to the frequency. So that's no longer the 50 or 200-day daily number. If you say are using like a 5-minute frequency or something like that, that's now 50 or 200 5-minute periods. Okay, I know that causes some confusion sometimes.
We had a few people asking, too, if these trend indicators and oscillators can be used for mutual funds and ETFs, or are they really designed to work only for individual stocks?
Yeah, great question. So you can. Yeah, you can use these for mutual funds or ETFs. So keep in mind, all these indicators, they're running their calculations based off of price data, right? So if you're running on mutual funds, of course, it only prices once per day, so your frequency is going to have to be daily. ETFs, a little easier. ETFs trade just like a stock, so all of these indicators would work just fine on an ETF as well.
Great, thank you for that. We had somebody ask when might you use one indicator the same type versus another the same type? For example, how does someone know whether to use stochastics versus RSI or on balance volume over money flow?
Yeah, so that's a question we get a lot, and here's the bottom line, right? There is no perfect indicator. There's no indicator that's going to kind of be able to project what's going to happen in the future kind of all the time. Okay, so if you keep looking for that, you're just going to kind of drive yourself crazy. So instead of answering which one's better, take a look and see, all right? Some indicators and also the settings of the indicator itself, okay, you might find that one indicator appears to kind of, quote, confirm signals better than others on a particular security, or you might just prefer, for whatever reason, I know kind of everybody on the strategy desk, all the clients we talk to, they have their own quote setup, so to speak. But the thing is, there's no really kind of correct mixture. If you're trying to debate which one to use, look at them all at the same time. See which one seems to kind of, give you a kind of maybe a better signal or, maybe better confirmation, so to speak. So from that aspect, it's kind of trial and error, right? The only thing I would mention is if you use the reason why you don't use multiple indicators from the same category is a lot of times they will give you a similar signal. And remember, what we're looking for is confirmation. So if we start with price and we add a momentum indicator to try to get, gain confirmation on a better decision to make, right? Well, if you have another indicator that kind of generates a similar signal, that extra confirmation doesn't really help you, all right? That's what Trey mentioned of indicator overload. Okay, we don't want to have multiple momentum, you kind of want to kind of have things that might confirm each other but looking at different data points. Okay, so again, kind of one of those things where it's like, which one kind of quote best. there's really no correct answer for that one.
Great, yeah, great questions, everyone. So we appreciate those. So we'll continue on. We'll finish up the last few types here, and then get into the demo. We should have a little more time for a few more questions at the end. So we appreciate those. So yeah, in terms of volatility indicators, what we want to cover here today is first and foremost, we're going to talk about Bollinger Bands. A very common one we see with volatility, unfortunately one we see misused quite a bit as well. But what Bollinger Bands are, these are a type of price envelope. They help determine when prices are high or low on a relative basis. So they're used in pairs, so we have both upper and lower bands, and these are used in conjunction with a moving average. Further, the pair of bands is not intended to be used on its own. So it's a very important concept there. We're not using on these own. We're using the Bollinger Bands to confirm signals given with other indicators. So the bands themselves are constructed using two parameters, right? We have period and standard deviation. The default values that are used are the 20 period and 2 for standard deviation. And again, these can be customized depending on your own trading needs. But how these work, as the bands tighten, what this is telling us, the likelihood of a sharp price move in either direction is higher. So this is indicating a newer trend may be getting ready to begin. As the bands separate by a larger amount, so think of we're in an increased volatility environment, it may be signaling the end of a trend. What we do see is prices do have a tendency to bounce within the band's envelope, so bouncing off one band and heading towards the other. This can also help in identifying price targets. Main precaution with this, though, is that the price can often hug a band for long periods of time during a strong trend. And that strong trend continuation can be expected when we see the price move out of the bands. However, if the price comes right back inside the band, then the suggested strength is negated. So let's take a look at this one on the chart here. All right, and this is a good example. This shows a lot of different ranges that we'll see Bollinger Bands in. So if we start at the beginning, we see that area of lower volatility. Bands are beginning to narrow and tighten here, which is a signal that a new trend perhaps is about to form, which is exactly what happens. We do see the price enter into an upward trend. And this is very important too. We see that in that rising upper band, the Bollinger Band prices are basically hugging that band all the way up. Right, eventually we fall into another kind of sideways market where we run into that period of oscillating bands. This is where you can see the evidence of us bouncing off the bands, right? Price drops down to a low in that first red circle, right? We reverse and go up to the next red circle, reverse back down. In this type of market, those are generating buy and sell signals. But again, the reason you want to be careful of using Bollinger Bands on its own, is an example of that riding the upper band, right? If we hit that top band, you don't want to sell out there and miss that full upward trend. And again, this just emphasizes the importance of using other indicators to confirm each other.
Yeah, so the next indicator we're going to cover is average true range, and this actually is commonly used by traders and investors for like exit and entry points, and we'll get to that in just a second here. So again, what is this? Well, it's the average, what's called true ranges over a specified period. Okay. That true range is the greatest of one of three things that they look at. So it's going to be the current period's high minus the low, or basically the range, or the absolute value of today's high minus the previous period's close, or the absolute value of today's low minus the previous period's close. And the reason why it does that is so it can account for gaps. Okay, and again, typically this is based off of 14 periods. Again, it can be intraday, daily, weekly. You can definitely tighten it up for shorter, for more recent volatility. Again, the author describes 2 to 10 periods. You can also use longer term volatility for 20 to 50 periods. Again, also that frequency, intraday, daily, weekly, can be used for kind of different lengths of time. But essentially what this does is it accounts for increased volatility in the security. Okay, and we also want the absolute value because we're not really caring about which direction. Okay, it can indicate selling or buying pressure. So how does this help us? Well, again, if price starts moving more volatilely, ATR will increase. Okay, if you have, say, smaller ranges or maybe a quiet period, it's going to have a lower level. So how is this useful for kind of stops or entries? Well, there's a lot of traders and investors there that use like what's called fixed exit points or entry points, whether it's a couple points or dollar amount or percentage. But again, not all stocks behave the same, right? And if you're just looking at an individual stock, it doesn't always behave the same way all the time. Okay, especially maybe when events are coming up, say like earnings. So if we look at the next slide here, okay, we can see exactly how this could benefit us, right? We can identify when maybe we're in this heightened level of volatility. So if you look at the first outline in the middle, you can see there's some pretty big price bars, okay, and ATR reflects that with a higher reading. That's an actual numerical value, okay? That's how it can be used. In addition, if we look at the second outline, okay, you notice that there's an enormous gap up here, okay, and that is also reflected in the value of ATR. So it can accommodate gap up in price. So how is this used? All right, well, if you use a fixed percentage, you notice before the first red box, price is kind of trending up, but each actual bar isn't that big. Okay, then you have some pretty big price swings. So say you own this security and you were using like some type of pre-planned exit strategy, like a trailing stop. Okay, well, it wouldn't make sense to use the same level. Okay, well, in the quieter period, then kind of that whipsaw, because you could get kind of shaken out relatively quickly, perhaps. So again, it's not an ironclad method, but it does give some adaptability to the current market conditions.
All right, so moving on to the final type of indicator, which is the support and resistance. So the first webinar in the series covered support and resistance in detail. Today we're going to focus on just one specific indicator to identify support and resistance. So as a quick refresher, support and resistance levels, these occur at reversal points. These reversal points are where buyers and sellers are evenly matched and neither is really dominant. They're important because prices tend to stop at these levels in the future. And also breaking these levels implies that a buyer or seller earlier holding the price at a support or resistance, are now gone. Now in the first webinar, we showed how you can, draw support and resistance with a horizontal line. In some cases, if you look at a chart, it may be very obvious where those levels are and you can quickly draw it on the chart. However, unfortunately, in some cases, it may not be so apparent. So using an indicator is where you can get some assistance there. So we're going to take a look today at Fibonacci Retracements as that indicator. And the Fibonacci Retracements are actually based on the Fibonacci sequence. They're displayed by using a trend line between two extreme points. So basically, we're plotting from very low to a very high or from a high to a low. The percentage retracements identify possible support or resistance areas. Those levels are 23.6, 38.2, 50, 61.8, 100%. Just to bring up, if anyone studied Fibonacci sequence, just to bring up, the 50 is actually not part of the sequence itself, but it is a common level that's looked at by traders when analyzing retracement. So we will focus on that line as well. But ultimately, applying these percentages to the difference between high and low price for the period selected, this creates a set of price objectives for us. Depending on the direction of the market, whether we're up or down, prices will often retrace a significant portion of the previous trend before resuming that move in the original direction. And these counter trend moves tend to fall into certain parameters, which are often on the Fibonacci retracement levels. So let's take a look. We've got a couple examples of the Fibonacci retracements here. All right, so the first one here, what we've plotted is from the downward slope here. Right? So, we've taken from the very high, we've drawn to the very low. And what we want to look at is after this trend reverses, as we continue to go up, as we near those retracement levels, and just focus on the price of the stock as we near those levels, right? As we near the very first level, that first purple line, you see a little resistance that we've come there. We continue to move up and up, encountering the other retracement levels. And ultimately, we're going to hit the red circle at the top, right? This is at the 61.8% retracement, right? So this ultimately worked out to be an important retracement level. We reversed off of that, and you actually see how the price tends to use some of the prior Fibonacci retracements as support before ultimately reversing, breaking through that upper 61.8, and then continuing that upward trend. All right, for the next example, we're looking at it from the other direction, right? We're drawing from the extreme low up to the extreme high. And so after we hit that high point, we're looking at that retracement now, right? We see the price reversing and coming back. You actually do see, quite a bit of support there at that first retracement level. But once we bounce down to that 38.2, this is signified by the red circle on here. You see we reverse off at this point, run into some of that same previous resistance level before breaking through and ultimately continuing that upward trend.
Yeah, and just to kind of reiterate, just like we did at the end of the trend indicators and so forth, again, we're focusing specifically on the indicators themselves today. But again, it always starts with the price, okay? And what the indicators can sometimes show you is maybe things you're not seeing that the price by itself can't show you. So again, we start with step one, price analysis, try to gain confirmation or the divergences with these indicators to try to make a better assessment of where we feel we're at. And again, it's always going to be, positioning yourself and then reacting to new information as it comes along.
All right, and then just to summarize, again, what we've covered here today, again, there's 5 main indicator types that we covered here: the trend, momentum, volume, volatility, and support and resistance. And, I know we've said it a few times, but again, analysis of technical indicators, it really is just one aspect of technical analysis, right? So ultimately, we're incorporating other factors such as chart patterns and some of those previous things we covered in the first webinar, drawing trend lines, using peaks and troughs. We're putting all this together into a trading system.
Yep, and so in a way, it's just a way to try to make decisions, right? So the takeaways is try to use indicators from the different categories. The reason is they're usually based off of kind of different, calculations or data points. If you use indicators from the same type of class of indicator, a lot of times they're going to be very similar. So we just had that question of RSI versus stochastics. Again, I mean, we can take a look at the demo, maybe adding both of them on at the same time. A lot of times they're going to generate, somewhat seeming similar signals, and that really doesn't help you, okay? We're looking for confirmation or divergence from the price that we're seeing. All right, so, I mean, again, just to sum up, I mean, you're really never going to be one step ahead, right? That's impossible, okay? You can't predict the future. You're just trying to react. You're just trying to be a half step behind as close as possible, just reacting to the new information that comes along. And again, so indicators are just really helping us confirm or diverge from what we feel like we're seeing with the price.
All right, and just to show you a few additional resources that we have available. Highlighted on here, this is from our Learning Center on Fidelity.com, which hopefully everyone is familiar with. You get there by going to the Research menu in the Learning Center from the website. The first box, the technical analysis, if you go in there, this is a series of articles and videos covering all aspects of technical analysis, from beginner all the way to advanced. I mentioned if you happen to miss the first webinar or not familiar with some of the basic concepts, there's a really great course in here that's set up, Beginner's Guide to Technical Analysis, which is a really excellent primer there. The second box you see is the Technical Indicator Guide. So all of the indicators that we discussed today, as well as other indicators that are available on Fidelity.com or Active Trader Pro, are all referenced within this guide. The great part about it is the guide actually allows you to sort by indicator type. So if you're interested in looking for a trend indicator, you choose trend. It'll give you all the indicators we talked about, plus other ones. In each of the individual indicators, we give a write-up about how the indicator is derived in terms of the calculation. We have an example on the chart, and then practical use. Where is this generating signals? So really great reference point for you. as you're learning about technical analysis.
Yeah, so this is a screenshot of what the indicator guide actually looks like, and the best part is if you're already using Active Trader Pro, you really have quick access to this. Just click on the Help menu, drop down to the Learning Center, and the technical indicator guide's right there. So that's the first thing you should do if you are, say, adding an indicator to your chart and you maybe notice something else and you want to learn more about it. Just come right here, right? It really does a great job. It's not going to take too much time. The indicators that have kind of complex math, we don't get bogged down with the math. We don't really care about that, right? How do we use this? And if it's interesting to us, how can we incorporate it into our trading process?
Hey, Trey and Rob.
Finally, just to bring up, as we mentioned, we're in a 4-part series. Just to remind you that I think Denise mentioned early, our second one, Identifying Chart Patterns, will be on September 16th. And the final webinar in the series, the Gaining Confirmation and Managing Risk, will be October 27th at noon. Again, you can register for those now if you sign up for them ahead of time. We'll remind you as you get closer to the date. And additionally, before we move on to the demo, as I mentioned, our strategy desk, we do speak with clients as well about how you can use technical analysis in your trading process and decision making. If you have any additional questions, you'd like a follow-up directly from one of our team members to discuss your strategy, feel free to leave your name and number in the chat, and we'll give you a call.
Yeah, so we're gonna launch the demo now, kind of go over some of the concepts and cover some of the indicators that we presented today.
All right, should be populating here in just a moment. So, and what you'll see when this starts to stream for you is we're actually taking a look at the Active Trader Pro software, and we've got a chart drawn on here. Again, the security we're using today is not a recommendation. We're just using it for illustrative purposes. We were looking for something where we could identify, some various areas of a trend, areas where we see a clear down, sideways trend, and an upward trend. If you are users of Fidelity.com, the advanced chart feature on Fidelity.com is going to look just like this, and the way you'll use the chart is exactly the same, right? So all the menus that we're going to go through and add, you'll be able to see there as well. So we want to start out, we started the webinar by talking about one of the real core principles, which are the moving averages. So we're going to go ahead and start the demo by showing you how you can add those moving averages onto the chart. And the way we're going to do that is simply by going to the Indicators tab. And this is actually a left to right scroll. So we're going to scroll over to the right. And we're going to add the simple moving average. So as we mentioned, two of the common are the 50 and the 200. So we'll start with those two. What you'll notice, we've drawn a red line on here. At the top here, this heading, this is where you can actually customize the indicator. So as we notice here, this is a 20 in parentheses. That indicates a 20 period. Just to follow up on the question from earlier, down here, our frequency daily. What this is telling us is our periods are daily, so we're actually looking at a 20-day moving average right now. We're going to click this, and we're actually going to choose Modify. In here, this will allow you to change everything from color to line thickness to line style. But the main thing we want to focus on here is updating the period for this. So we're going to take a look at the 50-day. And we're just typing 50 in there and clicking Apply. And this is going to give us the 50-day. Now to add the 200-day, we're basically doing the same thing. We go to Indicators, choose Simple Moving Average. It's going to draw the moving average here at the top. We're going to modify, and we're going to change this to 200. And you notice too, the default period on here is the 20. So 20 is another common period that traders use. So we'll leave this one up here. We'll draw that as well and leave it as is. That'll show you a little bit more about using that when we have the Bollinger Band up here.
Yeah, so, as we talked about, it's not just about the simple moving averages. It's the price in relation to the moving averages and also the moving averages potentially crossing over with each other. All right, so, moving from left to right here, what do we see from about from about, looks like October of 2013. Again, we're looking at a 2-year daily frequency chart, okay, up until here, okay. Looks like kind of, at least a intermediate term uptrend. And you'll notice that the price kind of rides this 20. Every time it pulls back, looks like it found support there. Okay, and that's, again, one thing that people look at for moving averages. Okay, and then conversely, okay, in the subsequent period, price sharply turns down. Okay, price reacts first, of course. And then what do we see afterwards? Well, we see the very quick 20 period, okay, moving below the 50, right? But again, notice what's happening with this much slower 200 day, right? Takes a lot of time, okay, because there's so many periods, okay, until this thing starts really reacting. Okay, but again, it always starts with price, right? We have crossovers here, crossovers here. These are potential significant points, again, but it's always looking to confirm what we feel like we're seeing with the price first. Okay, so to kind of go to that example that we had on the moving averages, well, we're seeing a gap up here after kind of this sideways trading, right, followed by these shorter term moving averages, first being below and then crossing above. So these would be the golden crosses, right? And in this case, it happened to coincide with a beginning of looks like a breakaway uptrend here.
Yeah, so and ultimately what we're looking to do here is, as I mentioned, trying to use indicators of each type to gain confirmation. So we're going to add, during the demo, a few other indicators here of the different types and really take a look at how these work in conjunction. So let's do the volatility indicator next, and we're going to go ahead and add the Bollinger Bands on the chart here. So again, I click the indicators and just choose Bollinger Band, right? This is actually going to draw the Bollinger Band envelopes on here. And again, the heading at the top, this is where we can go to modify, right? In this case, we'll leave the 20 and the 2. But for example, if you maybe had a longer trading time frame and you wanted to adjust to a longer period, you can make those adjustments here. And we can also make adjustments to color, line thickness, basics there. And to focus to one of the reasons I wanted to leave that 20-day moving average on here, right? When we look at Bollinger Bands, it is in conjunction with the moving average. So the 20 period in the Bollinger Band actually corresponds to that 20 period moving average, right? So that envelope is forming based on a multiplier by standard deviation above and below the moving average.
Yeah, and so I think Trey mentioned that a lot of times when you see kind of contraction in price, it can potentially be a signal that maybe price is ready to break out. And I really think a good example of this is on the far right of the chart here. Okay, so if you look at, what is this, looks like the end of May, okay, right, we have kind of a tight trading range, and here's that classic bouncing off the top band, pulling back, bouncing off the lower band, and so forth. And this is that breakout that Trey was talking about, okay? When price actually accelerates out of the band, that could indicate a potential strong move until, okay, pulls back in here. So compare that to here, where it breaks out, but then it pulls immediately back into the band, so that kind of signals that maybe that potential move is at least potentially stalled, so to speak.
All right, so let's go ahead too. We want to add obviously a momentum indicator here as well. So we're gonna, for this example, we'll add RSI. So again, we're going up to the indicators menu and choosing the relative strength index, and you'll see it'll draw this oscillator here on the bottom of the chart. So a few interesting things that we look at on RSI. One thing to point out, and just this is also show you how to do this, is when we talked about looking for those divergences. And we can plot those pretty easily. I'm going to the draw tool right now, and I'm choosing the trend line just to highlight kind of an interesting divergence here we see with RSI. And as you notice, you can draw these trend lines directly onto the oscillator as well as on the price. Right, so what we see here, a period where the price is actually hitting new highs, and RSI is actually diverging, right? We're getting lower peaks as we go through, signaling a bearish divergence, which ultimately we see how that ended up playing out on the chart.
Yeah, exactly. And in addition, what was one of those characteristics of RSI, right? That it can stay kind of overbought and oversold for extended periods of time. And if you feel like you're potentially in an uptrend, what do we talk about? RSI may stay over basically the 40 level. So kind of going back to some of our drawing tools here, again, draw trend line. Maybe we're first starting with price over here, okay? We feel like maybe we're in kind of an uptrend right here, okay? So what we're then going to do is now look at what is RSI doing. So we have quick access to a draw tool right here, okay? And then we can come down to the RSI and just give it a quick draw. And I'll leave it at 50, even though it's technically like kind of that 40 range. But what do we notice about RSI when we're potentially in this uptrend? Well, it never actually gets to, okay, and again, an oversold level, okay, and that can be very typical of how RSI behaves if you are in fact in an uptrend.
All right, so we're next we want to add a volume indicator. Let me close this out here, which we're going to actually add the on-balance volume here. So again, we're going to the indicators, and sorry, these are all in alphabetical order, by the way. All right, so we'll add the on-balance volume here. So let's take a look in the same range that Robert was pointing out with the RSI. Let's take a look at what volume was doing here. So again, we're going to draw a trend line just to point this out. But as you see, as this trend continues to go up, right, we're getting kind of confirmation from volume, right? Volume is increasing, signaling strength of trend as we continue to go up here.
Yeah, exactly. So, I mean, kind of bringing everything together, what are we looking at, right? Well, we start with price, right? Then we have, say, a momentum indicator. Then we say we have a volume indicator, right? So all these different types of things are basically kind of pointing in the same direction. Now, does that mean it's always going to work? No, there's going to be plenty of times that it doesn't. But we're just trying to give ourselves the best chance to make the best decision. What is the current condition that we're in? And we're going to operate kind of under that premise until the charts tell us otherwise. And that's that prediction versus reaction kind of subtlety that a lot of people have questions on.
Yeah, and of course, we talked earlier, there are many different types of indicators. We showed you many different examples, right? As you're doing this, right, you may find another momentum that you want to use or another volume that you want to use. We'll actually give you a few examples. We'll show you some of the other ones, but, individually. I think we had some questions on Fibonacci's too, so we'll draw one of those on the chart here too. All right, and I want to show you too how you can remove these indicators too. I'm going to remove a few of these just to kind of clean the chart up a little bit so we can get a good view of the other indicators we're going to add. So that's part of the indicator overload, right? As you add too much, you almost can't tell what's going on. So we don't want to add anything else. This is kind of a typical example here of a potential setup. But for the oscillators, the bottom right, you can actually X out of each of these to clear those off. For trend lines, we click on the line, we can click remove, and then any of the indicators up here, you'll notice if you click, you'll get the option to delete. So I just want to clean this up just a little bit. So I want to take a look at the Fibonacci retracements here on this example as well. So to find these, we go to the draw tool at the top. And it's actually this little set of horizontal lines. And if you hover your mouse over it, what we're going to see is the Fibonacci retracement. All right. Now, the example I want to show is actually relating to this sort of short down trend that we saw here earlier. This looked like a pretty good example. So all we do is we click at the top, that high extreme point, and we drag down to the low, right? And this is actually going to plot the retracements here for us. But as we see the price kind of reverses off here, we can really see why these levels are important, right? So after this reversal, where do we come first? We actually hit this 23.6 retracement. Hit it once, pull back, hit it twice, pull back, and then the third time when we actually cross it, we see that's a big move up, actually break out to the next line, right? And you see 38.2 similar. We're in this range 1, 2, 3, and then finally break out on the fourth time. And then ultimately, we do hit the 61%, 61.8, which this one turned out to be a major reversal point. We hit that top and couldn't break through and continued back down.
Yeah, so a lot of these levels, it's easy to look back when it's already happened and say, oh, that looks obvious, right? But, as it's happening, why are these levels significant? Are they significant because Fibonacci's are significant, or are they significant because many people use Fibonacci's, right? If anybody's read about a theory called Elliott wave theory, okay, Fibonacci's are usually incorporated to try to determine kind of wavelength and things like that. So, again, this is just another tool. If you notice, even if you didn't use Fibonacci's themselves, if you look at the bottom of the chart, okay, kind of going back to part 1 of the series, support resistance, well, we have a point, okay, at that represented by the 0 line here on the Fibonacci tool, where it comes down to, but then it hits that point basically two more times in the future. So even if you weren't using Fibonacci's, you were just using something more straightforward like support resistance, okay, that might have been maybe your support line, okay, and it managed to hold, right? Okay, so again, remember, don't think of each of these things in a vacuum. Think of it as part of your process, and I think that's where a lot of people, when they first kind of start technical analysis, sometimes they lose sight of that fact. Is we're just trying to build a process for making decisions.
Absolutely, great point. And I think if you are using retracements to maybe plot futures, so we like to look at the past. That really gives a good example of how it works. But with the active trader charts, right, you do have the ability to. I'm just clicking and dragging where these carrots are, and we can actually move the chart over, right? If we want to see some space and start to determine where these important levels may be. Right. Same type of analysis, right? We're drawing from the very bottom up to that extreme high, right? Now this, is giving us, maybe some possible retracement levels on the way back down.
Yeah. So why don't you, if you don't mind, Trey, why don't you add, because we had the question of of the same type of indicator. Why don't we add both, say, RSI and maybe slow stochastics?
Yeah.
Just kind of see the differences between a similar type, kind of similar class of indicator.
Absolutely. So we're going to go back to the indicator, do the slow stochastics, and then we'll do the RSI here next.
Okay. Yeah, so again, remember when Trey talked about stochastics, it kind of works better in slow-moving trends or sideways trends. Okay, so if you look at various parts of this, this price history that we're looking at, again, the first thing you need to look at is, well, what type of condition, do you feel like we're in? Are we in an uptrend? Are we in a sideways trend? Are we in a downtrend? Okay, and we'll compare the two. Okay, does one seem to work better in a certain market condition than the other? Do certain levels, okay, seem to it might work better than others as far as overbought or oversold? I mean, if something's constantly getting above the overbought line and it never pulls back, well, maybe that's not a good setting for that particular security. But again, I think maybe a good place to zero in is the difference maybe between stochastics and RSI, at this kind of breakout of the sideways trend here. Okay, stochastics actually gets to an oversold level right here, where RSI doesn't come close. Okay, and we're in this kind of temporary sideways trend. So I mean, again, this is just something you kind of have to look at and say, well, which one's better? Well, again, they do kind of give you similar signals, right? So if you look at stochastics and then try to confirm it with RSI, well, a lot of times, even though they might not be exact, they kind of tell you different versions of the same story. So that really doesn't help you, okay? So not saying you can't use both, but again, just be aware if you're looking at one to confirm the other, most of the time, they usually will, okay? So I think we covered what we hoped to on this demo. Looks like we have a little bit of time for any additional questions. Denise, did anything come in?
Yes, definitely. 1 second. Should someone be using the same indicators and interpretation regardless of what they're trading?
I mean, that's kind of the same question as which indicators to use and which settings. I mean, this really, it's what seems to, give you better confirmation of what you're looking at as far as price. So there's really, what's the right setup, so to speak. Could be different for each security. Could be different for the styles of securities. Somebody asked the question earlier, can you do this type of thing on like ETFs versus stocks? Of course you can. But again, an ETF is typically a basket of stocks, right? So, is it going to have the same type of behavior, right? Well, we know if we add quickly here, looking at this happens to be Amazon. Again, it's not a recommendation, but we just happen to be looking at it. So if we go up to the top here, we can access earnings. Okay. Now, while technical analysis is the process of just looking at price, and basically it's meant to look at how fast price absorbs news, so to speak. We can clearly see, okay, that a lot of these gaps were driven by these fundamental events, right? These significant events. Okay, so you can't be you can't be oblivious to that, right? And if you're looking at an ETF. Okay, well, is an ETF going to have these significant gaps? Probably not, because usually there's a variety of companies in any given ETF. So you might not see maybe this type of chart on maybe a broad-based ETF or something like that. So to kind of go in with a mindset there's only one way to do things, again, that's not the point. There is no right system. It's really, this is what I trade, okay? What are the tools that I feel like help me make the best decision?
Going back to the Fibonacci lines, could you clarify where you start and end your Fibonacci lines?
Yeah, so what we're doing with Fibonacci's is we're looking to draw basically between two extreme points. So, what I showed here basically, this was the beginning of kind of a short downtrend, right? So I want to take it from, the highest point of that trend to the lowest point of the trend, right? So we're simply drawing it from the top down to the low, right? So that's basically it. This one I mentioned we're kind of doing for a historical point, right? We can see what's previously happened, but if you were to be, wanting to analyze where we're at currently, the current level, right? So, most recently with Amazon, clearly in an upward trend, right? We're going to be drawing our Fibonacci from, the very beginning of this trend, this very low point, up to that highest peak that we reached up here. So that's how we're going to construct this.
Yeah, depending on your time frame, you might find various points where you feel like there is a top or a bottom that you want to kind of assess. Again, think of the name, Fibonacci Retracement. Okay, so we're basically trying to identify a trend that we think might have turned, okay, and the retracement levels are where we feel like that might go back to, okay, before proving it either violates the trend or possibly turns back. Okay, so a lot of it is kind of subjective depending on what time frame you're looking at, what frequency you're looking at.
And you always do have to be mindful of the next the next trend, right? We're looking at a 2-year chart here and drawing it on there, but maybe you're even longer term than that, right? This is going to look vastly different on a 10-year chart, right? It looks like there's almost only one trend from here, right? So your points may be more extreme depending on the level that and time frame that you're trading. You want to match it to your own expectations.